Yields are very low right now and likely to rise for maybe years, could be a decade, could be longer as we get to historically normal levels of interest rates. The returns that you're going to earn through that period are probably below those that you've embedded in your savings plan. So how do you add to that? Well, the traditional way of boosting returns above yield would be to anticipate interest rate movement. Sell bonds before they go down, buy bonds before they rise. But the testing that we've done on that is a really low predictable source of returns. A more predictable and stable source of returns is to accept additional risk premia in your fixed income exposure. So rather than owning all sovereign bonds, how about blending in a little bit of provincial bonds or even some investment grade securities, or with even a smaller amount, how about some high yield securities outside of this country, maybe some emerging market debt, maybe emerging market local currency debt. So there's quite a rich palette of risk premia available to blend together. And when we do that, we get higher returns or yields into the portfolio. That reflects the additional risks that are taking. But by blending it through financial mathematics or optimization, sometimes you can get higher returns with lower levels of volatility, and that's actually our goal.
Fixed income is not what it used to be 20 years ago, 15 years ago, even 10 years ago. There has been a massive evolution in fixed income over my career, and I'd say there are three key drivers that I would highlight. One is the growth in the stock of debt, particularly in the era of quantitative easing since financial crisis. But remember, interest rates were low even before. So if I look between 2003 and 2018, so the last 15 years, the global stock of debt has grown from $100 trillion roughly to $250 trillion. So one factor is abundance of debt. The other factor, which is also aided by low interest rates, is increased number of issuers. And even if we look just at sovereign issuers, for example, emerging market countries, the emerging market sovereign index in 2003 had 32 countries in it. Today it has 67. Again, huge increase in breadth of the index. That's sovereign example, but the same applies to corporates. And finally, over the past 10 years in particular, the growth in data availability and computing power has created massive opportunities for analysts to dig deeper and be able to extract more information from the data, help them make decisions to add value. So the abundance of these opportunities has created more opportunities for tactical asset allocation and active management in fixed income, despite the drop in interest rates that accompanied these events. And generally, I would say that fixed income management became more specialized over that time. And fixed income portfolio management has more opportunities to add value than at any time in my entire career. Let's start with description of our credit abilities. So we go through the entire range of credit opportunities from investment grade through high yield and emerging markets, and we have deep credit teams doing analysis on the ground in several locations globally. Another lever would be a decision about investing within Canada or outside of Canadian fixed income markets. The management of the yield curves actually, since we're investing outside of Canada. Active currency management, and of course, interest rate management duration decisions.